Hey, everybody, welcome back. It's Jeremy Kloter, founder of the Tampa Bay Veteran Investors Show, and super excited for our audience today to interview Owen Lynn with Advanta IRA. And it's kind of one of the best kept secrets in real estate that we're hoping to expand your knowledge to of how to use your self directed IRA to invest in a lot of things, although we'll be more focused on real estate. And it's something that we actively use in our business and borrow money from investors that also lend money out of their self-directed IRA. But really excited to show you guys and kind of pull back the veil a little bit on something not a lot of people know about. So, Owen, I appreciate you taking the time today to educate us and walk us through your whole world. I mean, 10 years in the industry, that's a long time, man. A lot of experience.
Yeah, I appreciate that. Yeah, we do a lot of these sessions, and it's good to like walk through like case study examples and like just really show like the power of self-directed IRA. So, yeah, definitely appreciate the time. But yeah, I'm one of the business development reps at Advanta IRA. I also do a lot of outside presentations and events and such as well. But we basically have a deck today. We're going to run through some different case study examples. Show some of the more interesting things like using a solo 401k, doing group deals, stuff like that. Kind of the more interesting transactions that we see here at Advance IRA. So, but yep, no, appreciate the opportunity to come on and speak today. And then just a shout out to you as well. Thanks for. I'm not sure if they're able to see the slides throughout the presentation. Thanks for the shout out. Thanks for the shout out, the opportunity as well. Just to get started, just a quick disclaimers. Advanta IRA and its employees, we don't provide investment advice or endorse any products. So all information and materials are for educational purposes only. We always say it's good to speak with CPA, attorney, financial advisors, whomever is in your professional outside counsel before you decide to invest. And then just a little bit of background on myself. So been in the industry for over 10 years. I do carry the FINRA licenses as well, such as the 763, 65, but have worked on both sides of the fence. So worked at a number of broker dealers like TD Ameritrade and Merrill Lynch, all the way to different custodians, including Advanta IRA, some other self-directed IRA providers as well. So it's been really interesting to see the contrast over the years versus managed money and then obviously self-directed where you're in the driver's seat. Then just a little bit of background on Advance IRA. So over 23 years of experience in the self-directed IRA industry. We're considered one of the nation's premier self-directed IRA providers. Our team is mostly comprised of like MBAs, CFPs, and a majority of our staff does carry the CISP designation. So that's the Certified IRA Specialist designation. It's a test that you actually have to go and study for. And then we're considered trusted. So we actually just crossed over 4 billion in assets under administration and custody at Advance IRA. And we work with a large network of CPAs and attorneys as well. So we'll often share if you're looking for a CPA or an attorney for anything specifically investment related, feel free to reach out to us. We do have a pretty large network that we're happy to share with you. And then we're considered secure. So what I mean by secure is all uninvested cash in the self-directed IRA is going to observe the FDIC limits, much like a broker dealer or large bank. The same exact protocols would apply to Advance IRA as well. So you're going to observe FDIC limits, going to observe a lot of the same banking regulation, broker dealer regulation, because we're actually a chartered trust company. So we're regulated in pretty much the same ways. And then we are considered personal. So like the main thing with us, that's really kind of like the differentiator in the industry is that every client is assigned to a dedicated account manager. Instead of like calling into like a 1-800 number, waiting on hold, all that jazz. With us, you are assigned to a dedicated person. So we have 29 account managers now that actually oversee all of our clientele. So really happy to have all of them on board because they're keeping the operations rolling every day for us. And then this is just a team picture of us. So this is about 3-4 months ago, but been in business since 2003. We now have over 60 staff members. We have multiple locations as well. So our headquarters is in Clearwater, Florida here, but we have a facility in North Carolina, in Georgia, and then we have another satellite office that's going up in Dallas, Texas. That's going to be a little bit later this year.
And you guys pretty much like, obviously we could do anything nationwide. Are people able to do stuff in their IRA like outside the US, or it's pretty much like, hey, it's restricted to just inside the US, and obviously you can operate in all 50 states as far as territory and stuff.
Yeah, no, it's a great question. So right now we're seeing a lot more investments that are happening internationally. We're seeing a lot of money leave the US and go to South America, go to Europe and different strategic accounts as well. So we are one of the few custodians that will entertain foreign investments. So that's also an area that a lot of companies our industry are kind of they're not really privy to it, or they don't really want to touch it, but we will.
Yeah.
So we do a lot of the foreign stuff as well. Yeah.
Yeah, and these guys are gonna help you stay out of hot water when it comes to compliance and, making sure that the tax man doesn't come hit you with some some penalties, which we'll get into, but awesome, man.
Yeah. No, yeah, the account managers are kind of a saving grace. So they're gonna notify you if there's anything that's tax related, if there's anything you should be aware of before making the investment. So that's why again, we really prefer to have everybody have a designated person with us. So yeah, also for those that are new, rolling through here. So basically a self-directed IRA, like, so what is a self-directed IRA? What makes that special versus like my normal IRA that's at Charles Schwab or TD Ameritrade? So basically the differentiator here is that with a self-directed IRA, it has to be with what we call a custodian, administrator, but mostly like you're going to be looking for a company that's a chartered custodian. For example, we're chartered out of the state of Nevada, for example, but we work in all 50 states. We're individually licensed in all 50 states. So that's different from a broker dealer. So broker dealer is just going to be like your stocks, bonds, ETFs, mutual funds. But a self-directed IRA, if you're working with a custodian or administrator, then you're able to hold different asset classes such as real estate, precious metals, private equities. That's like investing into private companies. Think about the big example is always Peter Thiel, like when he put his PayPal shares in the Roth IRA. It's like 14 years ago at this point, and now that Roth IRA is like a $5 billion Roth IRA with the private equity in it. So that, I mean, that's just a very blatant example, but you're essentially investing into private companies. Like we have people that did Facebook, that were part of the original funding rounds, and they used their self-directed IRA back in the day. And obviously they just made like just oodles of money. Um,
Yeah.
they're able to cash out. But yeah, just some of the different examples of some of the different
And it's important to
assets you
note
can
because a
hold.
lot of people get so used to, like, a standard W-2, they're probably so used to just the company 401k. Probably don't have a lot of options to invest in, whether it's US based or outside the US or crypto or anything. It's fairly limited. I mean, we have one for our company too, where it's you can kind of play with some of, but you don't have a lot of control over maybe what you want to invest in. And even if it's stocks and stuff, there's not a lot available, right? So even if somebody's got that, or they leave their company, they want to transfer it over to self-directed. But even if they're doing the 401k through W-2, this is a great thing to look at. Hey, some extra money, you can have a little bit more freedom in what you want to invest in. And, it's a great alternative, especially for those people that like real estate or just want to try some other things rather than what their company's got them stuck into.
Yeah, absolutely. And I think that's a great segue to. I always just kind of list off this disclaimer as well. So 65% of companies out there are not publicly traded; they're private. So there's that entire other side of the coin of investing into private companies versus just the public ones that are actively listed in the stock markets. A good example is that we did put together a recent partnership with a company called Hive. So that's spelled HIIVE. So that allows investors direct access to invest into private companies such as like Anthropic, SpaceX. Again, not a direct endorsement, just throwing it out there that it is one of the example categories that we do here. So you can invest into those private companies versus only being confined to investing into the public stocks in the stock market. So yeah, it's just a great example. But yeah, also categories, just a brief mention. So we have like crypto and Bitcoin. We have oil and gas, mineral rights, real estate, obviously, your startup companies. And then the other big category is private lending. I usually use the example of my father. He's been doing this for the last 10, 15 years. So private lending is where the IRA is essentially the bank. So if I have, say, 50,000, 100,000 in my self-directed IRA, I can fill out a promissory note sheet and just upload that to Advanta, and that's going to be the terms and conditions of that loan. And then I can issue that money out to other friends, other businesses, other people in my network. And so I'm essentially creating a private loan. So that interest is going to roll back into the self-directed IRA over time. And then at the duration of the loan, when it comes to an end, the balloon payment would come back in. So that's just a
Yeah.
great example.
Yeah, well, when we were at the investor meetup the other night, it's like you could do the rental properties, you could do a flip, you could do land deals, you could do wholesaling. I mean, obviously the money comes out, has to go right back into the IRA, and I'm sure you'll get into some of the specifics around like who I think there's some rules around who you can and can't do deals with, like your own, like there's family member sort of guidelines and stuff that we'll probably dig into, so you make sure that you're in compliance, or you can't. If you own a rental property that is in your IRA, you can't really be the handyman doing the work on the property as well at the same time. But some nuances just to make sure if you guys are doing some of that deals. But it's a great thing to really say that there's almost like if you can think of investing in it, you probably can, which is completely different from what we've traditionally been taught on. What you're stuck into is just stocks or something with a 401k. So
Yeah, absolutely. It just has to be structured the right way. So we'll touch on they're called the prohibited transactions. So there are certain things that you'd want to stay away from. You wouldn't necessarily want to approach with a self-directed IRA, but we'll cover some of those. But yeah, absolutely right. It's just a completely different world. Most people are just unaware, honestly. So only 5% of IRAs in the United States are self-directed like this. This leaves the other 95% that all of those, hundreds of millions of people that will never learn about this, will never, learn that it exists. So that's kind of my job is just kind of informing people of like all the options that are available. And that applies to all account types as well. So basically, on the screen here, we're going to cover like the different IRA types. You have a lot of the ones that you've probably heard of before, so like your traditional IRA, Roth IRA. So most people are kind of aware of what those account types are. So that's a pre-tax and post-tax IRA. So we also offer self-directed applies to all the other account types as well. So if you have an inherited IRA, so if you had like a family member pass away, for example, that could certainly apply. We can make that self-directed. And then your plans for small businesses as well. So that would include like your solo 401k is kind of the major one that a lot of people are aware of. And then the SEP IRA. So those small business plans, you can actually put in a considerable amount more. So with a solo K or a SEP IRA, I can go up to close to $73,000 a year now. I believe it's 72,500. So that is almost 10 times more than the contribution limit for a traditional IRA or a Roth IRA, which is just sitting at 7,500. If I'm
mhm.
over the age of 50, then it's 8,600. So that I mean, just a huge difference. So if I'm a small business owner and I get that tax write off as well when I'm putting that small business contribution in every year, I get to directly write that off. So if I max that out for period of years and let that grow and multiply, like I'm going to be growing essentially like 10 at like a 10 times faster rate, almost 10 times faster rate with the amount that I'm putting in, maxing that out versus just the standard traditional or Roth. So, and that's really going to speed things up. So that's why I try to tell people, like, if you have a small business and you're doing well, you're making profit, and you have a little bit extra that you're making right now, like put that into like a retirement account, and you'll just set yourself up for the rest of your life. So that's what I
Yeah, it's
always
like
just try
don't
to.
pay Uncle Sam if you don't have to. Instead of writing him a check, throw it in there, please.
Yeah, exactly right. Like if you have a tax bill, then you didn't make a contribution. Sorry, but yeah, I mean, you really need to check with your CPA or whoever you're working with. Like you need to be maxing that out. So there's no reason to be paying taxes and then not making a contribution, because that will just directly offset the taxes that you're already paying. So yeah, it's all, and we see it all the time too. It's just like people are just unaware. Again, it's just education. So it really, just comes down to covering like all the options so people are aware of what they can and can't do. And then yeah, just moving along here. So the former employer plan. So like, for those that had like a W-2 job, so like your 401k, 403b, 457 plan, TSP if you're government workers. These are all previous employer plans. Those obviously they can roll to a self-directed IRA as well. Once you leave employment, obviously we could just move that entire thing over if you want to into any IRA if you're choosing. If you're still employed, there's still a possibility that it can move. We would just want to check and see if it's eligible for the in-service rollover. So if you are like working a job right now, you have a 401k, 457. You can check with the plan administrator and just give them a call and just ask if you're eligible for what we call an in-service rollover. If you are, then by all means, you can feel free to roll that over to an IRA, and then you can start investing with that money as well if you're eligible to do that. So otherwise, you just have to wait until you leave your employment, or you turn 59 and a half at that
Yeah,
point.
it brings up a good point because when I got out of the military, a lot of guys that I served with that, some are may in and may still be in and retire, right? But even if you just do 4, 8, 12 or something and get out, like a lot of those people don't have probably not even thought about moving that over anywhere or that even it's possible. you know, through savings plan, I think is what the TSP was referred to, where you stacked up all this money and it's no different than that basically being your employer, right? So I think I've never really heard a lot of people promote that piece of it of like, hey, if you were in the military, like, you can just like what you would if it was with a company, you can, move that over and have a little bit more control on what you like to do with it.
Yep. And it's yeah, it's becoming more and more well known. Like we're going to it. It's only for active and previous service members, but there's going to be like a military investment conference. So we'll be talking about the power of like using that old
Awesome.
TSP, moving that over to an IRA. So, but yeah, absolutely. So it's just something that you'd want to check on. So, and that those are what we call rollovers. So if I have like a previous employer plan, that would just be designated as a rollover. But on the screen here, just to cover like a transfer. So again, you have these plans, and then the idea is that they can transfer over to self-directed IRA. Now, there's not going to be a taxable event that happens with doing a like to like transfer from one account type to another. So if I have a traditional, if I have a Roth, if I have a SEP IRA, I move that over to a traditional Roth or SEP with like say Advanta or another provider. I'm not going to be taxed on that at all. There's no way to be taxed because it's a like to like account transfer. There could be taxes if I do a traditional to Roth conversion. So if I'm converting to a Roth IRA, then that's basically I'm making everything post tax moving forward. Then yeah, it's going to be some conversion taxes involved, but again, it's just a direct transfer for actually moving those accounts over. And then direct rollover, again, that would apply to like 401k, 403b, 457 TSP. Again, that's not a direct transfer. It's what we call a rollover. That's where the other provider will actually send us a check, or they'll send a direct wire transfer along with the coinciding with the 5498 form that's designating this is being a direct rollover. So again, non-taxable. It's reported on the form 5498 that you did a total rollover.
Yeah, it's super
And
easy to
then
do. Like we've done one before, and it's very small amount of paperwork. It's very painless to do. So
yeah,
I sound like a
it's
lot,
not
but us as the people with the money in the account is really not too much to do. It's not a big barrier to entry. It's pretty seamless.
Yeah, and I'd agree. I spent a lot of a lot of appointments as well walking people through rollovers. So I'll call over to like Fidelity, Charles Schwab. Like I have all their numbers memorized at this point because I'm so used to like calling them with a client to do a rollover. So yeah, you're just basically picking up the phone at that point. And then just like moving on to the different contribution limits here, different account types. So we have again the traditional and the Roth IRAs. So that's 7,500 a year. Those are kind of your normal IRAs. We have the SEP IRA, and then we have the SEP Roth IRA. So that's the 72,000 per year. Just a disclaimer: the SEP Roth IRA that came out through the Secure Act. I believe it was in 2023 under the Trump administration. It is a new account type. Beforehand, there wasn't a Roth component for SEP IRAs. Now there is. So that's kind of huge because you
I,
can just put that
I didn't even
post
realize that. Yeah.
tax money. You can just like drop it right in. So previously, it would be like if I put money into a SEP, it's just okay. Now I have to do this backdoor rollover into a Roth IRA. I have to do all this paperwork, and it's kind of frustrating for some people for sure. But the SEP Roth that just avoids all that. It's just like just immediately putting everything post tax directly into the SEP Roth IRA. So just kind of a disclaimer on that one. And then lesser known account types would be like the simple IRA. So this is a small business vehicle that makes sense for certain situations. If I'm a small business owner and I have less than say 10 employees, then a simple IRA could be an attractive option. So I can go up to $17,000 annually into a simple IRA. Over the age of 50 is 21,000. So again, you just want to reach out to us. It makes sense for very specific situations. We don't really see it all that often. But if you are a small business owner and you have like say less than 10 employees, it could certainly make a little bit of sense as well. And then we just have like the normal 401k plan for what we call solo 401k. So that again, it's gonna be like just like the SEP IRA. I can go up to $72,000 per year as a contribution into that. And then I have the ESA, so Coverdell Education and Savings Account. That's going to be for children under the age of 18 for educational expenses. That's $2,000 a year. And then the finally the HSA account. So we can also use those as well. A lot of people don't know that. So very, very common to have an HSA account attached to different, employer packages, throughout the years for different employers, like they'll offer an HSA. A lot of people don't know that, those HSAs are still floating around out there and they never like were utilized and they're contributed to. So see it all the time where we track them down. There might be like three or four of them, and then we roll all of them into one HSA. And it's just like, okay, like now I have like an extra like $20,000 here that I can use for doing different deals and stuff. Uh, just something to also think about. But so those are kind of like the account types, and then we're talking about contributions, like how much can I put into these account types. So we're just going to touch on like the different alternative investment options, like the most common ones that I would say that we see here at Advanta IRA. So starting with real estate, again, that would be like your typical rental property. If I own a piece of real estate in my IRA. It can be a long-term rental property. Then we have like rehab projects. So that's where actively fixing up that property and we're fixing and flipping it, putting the funds back into the self-directed IRA, kind of rinsing and repeating that process. Um, and then also we have been seeing a lot of like the Airbnbs and VRBO short-term rentals as well. So this one, you just a quick disclaimer on this one. So there's something that comes up. It's called UBIT tax. So it stands for unrelated business income tax. So it's an extra tax that can apply to IRA owned properties. If they're for two main reasons. So option one is I have debt leverage on that property. And I use that leverage to acquire properties. Like let's say it's 50% IRA funds, 50% non-IRA funds. Then 50% of my proceeds would be exposed to a little bit of what we call that UBIT tax.
Mm,
The other thing that a lot of people don't know that it can apply is like if I have a short-term rental property, if the government thinks that I'm running it like a quote unquote business, like if I'm treating it like a bed and breakfast, for example, for those guests, if I'm providing like hotel like services, then that can expose my short-term rental income to also be susceptible to that UBIT tax. So we always tell people like if you do have a short-term rental property, the best way to go about that is to not provide any of those like hotel style services, including like, like making like breakfast stuff, stuff like that inside of the VRBO or the Airbnb. So we tell people to stay away from doing stuff like that. Which we can break that down into like more detail if anybody has like an Airbnb that's listening to this. I'm happy to break that down for you in a little bit
yeah,
more detail. But
like for the rehabs as an example, or like even the rentals, like everything has to come from the IRA, right? Like if you find a new property that you're gonna fix and flip, you're gonna buy it in the IRA. You're paying the utilities, you're paying the lawn care, you're paying, I think, the real estate taxes, the insurance. You're paying everything out. It has to come from the IRA, right?
Um, well, if I was just buying it directly under the IRA, then that would be the case. But we can do a partnership deal, which we'll
Okay,
be showing some different partnership deals. So I can partner with myself, like great example. Like let's say I'm going to buy $100,000 property and I have 80,000 in my IRA and I have 20,000 in my bank account. I can effectively make that transaction happen. It's going to be a partnership deal, but what happens on the back end is 20% of those profits that are going to come back have to come back to me in a taxable way, and the other 80% are going to go directly into the self-directed IRA, for example.
gotcha.
So it's split equivocally at the front door and the back door. So
Okay.
what we
Same for
usually
like
do is,
expenses then. Like if you have a roof that's 10 grand, 80% of that would have to come from the IRA in theory.
yeah, in theory, that is correct. Yeah, so that'd be split up. Now, what we do in those situations is we would go ahead and set up an LLC vehicle. That's in the operating agreement. It's going to list yourself and it's going to list the IRA with the equivocal ownership interest. And then you can just use your debit card and credit card or
Gotcha.
checkbook just directly from that.
Okay, awesome.
So that's kind of like the more residential real estate. And then well, obviously we see a lot of commercial. So that would be like multifamily syndications, retail centers, see a lot of malls being converted to basically apartments. So we're seeing a lot of that right now. And then private equity, so that's where I'm investing into private companies before they go and they do an IPO. And then finally the private lending. So those are kind of like the main categories there. And we're going to jump into the case study. So I have a couple of them I'm going to be sharing just to kind of show like the power of a self-directed IRA. So we're going to start off. This is a real client called Travis, or named Travis that's been with us. So he's done a number of transactions, but we've used some of his stuff for case studies in the past. So Travis, basically his story here is that he had 150,000 from his old 401k. He found out about self-directed IRAs. He found out you could do all that stuff. So he decided to go ahead and roll that over to a self-directed IRA, which he did. And he wanted to invest into multifamily real estate syndications, which he had done in a taxable way, but he had never done in the self-directed IRA. So Travis decided to roll that money over. So the asset type here, if you're watching, you'll see like you'll see the different images that we have of this building. But the asset type is a 220 multifamily property. So the business plan, what we typically see with a lot of these syndications is their main objective was they wanted to renovate the units. So that would be full exterior redesign, improve the operations, and increase rents. That's typically going to be the goal for a lot of these multifamily syndications that are buying up multifamily property like this. So the hold period on this investment was 5 years. Minimum investment that they would accept from investors was 50,000. Travis decided, hey, he's going to keep the remaining funds liquid. That's up and above the that's up above the $100,000, but he decided to put 100,000 into this, so double like the investment minimum, and then keep a little bit of that extra cash working for him in a couple of different areas. So basically, the outcome on this one. So over the 5 year hold period, the sponsor of this real estate syndication, they successfully executed the business plan by renovating the units, improving the occupancy, and they increased the rental income across the property. So as a result, the asset appreciated and it generated consistent cash flow throughout the period until they exited. So the average cash flow that they're expecting for this was going to be 7 to 9%, with a 14 to 16% IRR, and the equity multiple was 1.8x. So basically, at exit for this, the property was sold to a larger buyer, and they captured the increased value during that hold period of time. So they were able to successfully exit. So basically, at the end of the day, Travis's $100,000 investment, with the cash flow and the sale proceeds, came to $180,000. So over that period, he made a profit of $80,000 during that whole period. So basically, just another great example of just set it and forget it investing. You find like a large company like this. We work with many different syndications. It's something that's absolutely it's available out there as well.
Yeah, the fees to use you guys, I mean, it's so low. I mean, it's like when you think about stocks or mutual funds or ETFs, you have like expense ratio or these management fees and all this stuff. I mean, it's like insanely, it's like almost a mute point. So for those who are there thinking, oh well, like does it cost money to hold my money with an IRA or to do paperwork for it? And like it's such a it's such a low cost. It's just a kind of quick side note that I thought about just explaining when you're factoring just your total return. Like it's a very low thing to have to spend to have your money in a self-directed IRA.
Yeah, and we'll touch on that a little bit as well. But yeah, at the end of the day, we're significantly less than like the 1% or 1.5% that typical advisor charges. So we're typically about a third or a quarter of that. So we'll kind of break that down at the end. But basically, what we're just running through is basically it's a 3-step process as far as like making this happen. So if you have an existing IRA, for example, that would just be doing an application right on our website. You're going to mark it as a transfer or a rollover in section 2 when you're filling that out. And then when you hit submit, we then get the application that we're going to process either the transfer or help you do the rollover, whichever one that you selected there. Now, once the funds are in the door, you're assigned to a designated account manager with us. So you would just directly reach out to the account manager. They're going to cover with you the paperwork that you need to get from the sponsor, help you fill that out, and then they're just going to send you a DocuSign. We tend to try to use DocuSign in everything that we do, just to make the experience seamless. So they'll be able to walk you through like the specific parameters of that investment. So that's kind of the 3-step process involved there. And then just like moving on here, so we're going to move on to case study two. So this is Jacob's Fix and Flip. So Jacob is another Advanta IRA client. It's actually local. Does a lot of his stuff in the Sun Belt area. But this is just another great example of stuff that's local and nearby that you can totally do in the IRA. So Mark was a 45-year-old real estate investor. He had approximately 210,000. Was sitting with his former employer. He had moved it to a traditional IRA. So he wanted more control. He'd already done real estate. He had already heard about self-directed IRAs, but never really investigated too much. And then once he did, he just decided that he'd rather do that versus the stock market. So what he did was he just opened up the self-directed IRA. We did a direct transfer, so those funds came over from the other IRA, and then he started looking at different properties in the area that he wanted to buy. This is the Jacksonville, Florida area. He started looking at the market and he found his very first one that he wanted to do. So basically, his Jacksonville purchase price was 150,000. He was looking at a renovation budget of between 25 to 50,000, and this one he ended up spending about 40,000 on the renovation. So that total all-in investment cost was just slightly over $190,000. And then within either 4 or 5 months later, he then sold it for 260,000. So he made a $70,000 profit in that short amount of time on a fix and flip. So what he basically did is he set up an LLC that was going to hold the IRA. So that's kind of on this slide. So we have companies that professionally do this. If you set up LLCs on your own, you can certainly do this on your own as well. Very easy process. So we're filing the articles of organization, get the tax ID number, and then we open up the bank account. But the LLC listed the IRA as the owner member, so we do see this quite a bit as well. So basically, you get all the same tax advantages, but we owned it in an LLC structure, just because that's easier to go into, like, say, a Home Depot or Lowe's and have a debit or credit card to pay for those expenses. So
Gotcha.
we can talk about that. But this was the before for the property. This is in Jacksonville, and then the after. Basically just was able to put on new siding, do everything else, and make the interior look modernized with the new furnishings and stuff. Fixing the roof. So this is a great example of just helping the neighborhood as well, bringing up the property value of other people's properties in the area. So just a great example of like the fix and flips. So yeah, and next next category would just be like raw land transactions. This is just another example. Do you want me to keep going?
Yeah, that's cool.
Perfect. So yeah, there's Jacob's Fix and Flip. So basically, we're going to be talking about flipping lots now. So this is another fairly popular category. So we see a lot of people that they'll buy land lots and they'll either do minor things to it, so they'll slightly improve it. Maybe they're installing like water or gas lines, or just making it applicable for like commercial purchases later on for like larger builds and stuff. But we do see a lot of raw land flipping. So this is basically about two land lots that were in Georgia. So Nick was a Advanta IRA client here, so decided that he wanted to buy some lots of land directly in the IRA. And he entered that purchase contract. Again, this is going to be the same for real estate, anything else that you do here. It would have to be in the name of the IRA and not himself personally. He listed it off as the IRA name. So in this example, it was Advanta IRA, FBO, Nick Palumbo IRA. So that was the full titling. So then he reviewed that documentation. He funded the purchase directly from the IRA account. So we were provided with those documents. We were able to close on these lots of land. So that money was wired directly out of Advanta, and for the actual closing. And then the title was vested in the name of the IRA, and then all closing costs were paid from the IRA as well. So that's the other thing. If I'm buying something 100% in my IRA, like the applicable closing costs, other fees that are going to coincide with that, those would just come out of the IRA as well. So just something important to remember, unless you're partnering with cash that you have on hand, then that would be a little bit different. So basically, the whole period on this was the 5 months. The property taxes and closing, again, were all paid by the IRA. So basically, he had the opportunity to buy these two land lots. So he had moved over 185,000, like I mentioned before. So basically, these are two vacant residential land lots, and this is in Georgia. So the purchase price per lot that he was targeting was the $22,000 per lot. So he had bought two, and that came to a total investment amount of bought two, and that came to a total investment amount of $44,000. So that was his all-in cost on these two land lots. So basically, the lots were acquired, and then he found a motivated seller who inherited the property and wanted quick liquidity, and that's how he came across this particular opportunity to buy the land lots. So just looking at the financial results here, again, this is over a 4-month period. So he bought that total amount of $44,000. And then the total sale amount was $74,500 after he offloaded these lots and he sold them just a couple of months later. So that came to a gross profit of about $30,500. When we look at the net amount minus the closing and minus the taxes involved, that came to $27,800. Again, mostly the closing here. We'll just decrease some of that a little bit. So basically, takeaway on this is that raw land is also a very up and coming category. We're starting to see more and more of that as well. Uh, and then you can just own that directly in the IRA. And then a lot of people just will buy it, sit on it, hold on it, and then they'll sell it a little bit later. And then some people will slightly improve it as well, like for commercial reasons. So that's it, the other main reason as well. So those are kind of some case study examples there. You have a lot of different things that you can do in a self-directed IRA, but the main benefits at the end of the day is, you have direct control over those funds. You're not at the mercy of like a financial advisor or financial institution making those decisions for you. You can leverage your retirement capital. You can put it into existing deals that you're already doing, and it gives you a lot of diversification. So often see with people like maybe they're fully concentrated in like certain stocks, for example. If you talk to a lot of financial professionals, they'll talk to you about diversification. Like you're going to have some, funds in a safer area. You're going to have some funds in a more aggressive area. So that kind of also applies to self-directed IRAs as well. So you're able to maybe use some of that money to go into more tangible assets. The statistic is that over 43% of ultra high net worth households in the United States are invested into private equity or real estate. So that's almost half of the ultra high net worth markets. Often bring that up. So if it's something like the most elite investors are doing in the US, they're basically investing into not only some stocks, but also some private equity and other real estate related ventures that, they were able to invest into and get some profit on. So I was always tend to bring that up. And then we had mentioned it a little bit before. So like the process to do this is very straightforward. Yeah, basically step one, you're opening the account. Step two is we're funding the account, direct transfer or rollover. And then step three is we're submitting that paperwork. Get in with your account manager, explain to them what you want to do, and then they'll help you get the paperwork in order. Submit that for DocuSign. Upload it. Put it through DocuSign, and that is pretty much the process involved. So pretty straightforward there. And then we were talking a little bit about the fees earlier. So pretty straightforward. We have a couple of different ways that we do this. So most of our clients are going to go the asset based route. So what that means is that if I have asset-based billing, if I have a physical, tangible property in my IRA, that would be a flat $345 a year. So it was a $50,000 property or like $5 million property, would still be the same rate. So paying us $345 a year to basically hold that. And then if I have a private investment, this would be like private equity, private syndications, or if I have a checkbook LLC IRA, then that would be $295 per year. So that would just be the all-in rate. We do have a one-time purchase fee of $95 to go into the investment. So just figure that, if I'm looking to make that private syndication investment with Advanta, then you budget $295 annually moving forward, and then the one-time $95 to actually go into that investment. So that's
That's
kind of
great.
like the fees. I mean, it's very straightforward. Yeah,
Yeah.
there's
I mean, you go to dinner at the steakhouse, you're pretty much dropping that.
right. Yeah, with a group of people. I know it's crazy. But yeah, most advisors are typically between 1% and 2%. I've seen a lot of advisors, specifically in the Florida area down here, that have been over 1.5%, which in my personal opinion, I think that's a little bit greedy. It's to each their own, but that's a significant amount of money. So if I have $200,000 with an advisor and it's 1%, I'm paying him about $2,000 a year. Versus if I maybe put that money into a syndication or piece of real estate, it's going to be about a tenth of that cost. So it's $295, And then, let's say you invest into something, you start getting a better return than what your advisor was getting you. Like say if you're averaging 5 to 8% or whatever the amount is with your advisor, and you invest into a syndication where they're paying out a flat 11% a year, and then you're already doing better, at that. You're already doing better at that junction anyway. So, but yeah, that's a great example. And then the metals IRA, that's very straightforward. It's just a flat 250 a year. So that's for people that want to buy precious metals. So we do have a lot of those as well. That's where you're holding like tangible gold, silver directly in the IRA name, and it's stored at what we call a depository where they hold those precious metals.
Awesome.
So that's kind of the example there. And then just something to touch on as well. So we were talking a little bit about the checkbook LLC IRAs a little bit earlier. So that is again the unique setup where we have an LLC. That LLC is established and the IRA is listed as the owner member inside the LLC operating agreement. So when we form that LLC, we're listing the IRA as the owner member. What that essentially does is that gives you an LLC bank account that is now under the IRA's umbrella. So they're all connected together. So if I set one of these up, the idea is that I can move funds directly into the LLC bank account from Advanta. Like we get the information, we send it over to your LLC bank account. Then from there, you're free and clear to have a checkbook, have a debit card, credit card. You can walk into like a Home Depot or a Lowe's, buy materials, pay a contractor without submitting that bill directly to Advanta. So the idea is that this is going to work out a lot better for folks that are doing fix and flip properties, or they're going to
For
like a
sure.
sheriff's auction. So stuff
Yeah,
like that.
that's awesome.
So basically, the cost involved with that is it's again 295 a year for the IRA. Now the LLC has an upfront cost. Now we have a partnership with a company called Solera, so Solera Bank. So their normal cost on this whole structure was formerly $799. It is now a flat $300 for all Advanta IRA clients. So we actually just started this partnership with them not very long ago. So this is huge because it's extremely affordable and it's kind of everything all encompassing in one. So it includes the LLC filing, the EIN, registered agent service for the first year, bank account, and everything is set up and ready to go within 3 business days. So they're able to move faster just because they're an internal bank as well. So they're able to have everything open and ready to go with you as soon as you're basically filling out that information with them. So this is key for like if you need to set up one of these very quickly, like buy on a time sensitive deal, then this is kind of like what that's there for, right? So we get everything up and running and in motion pretty quickly. So
Yeah, it's like within a week or two, you're rocking and rolling. So there's no crazy lag time. And if you're like, man, I heard a lot of options, I don't know what to do. It's like 10-minute conversation. Owen and his team will be able to give you guys an idea of the best options, or most likely best options. You might have a couple questions, or just do an intro between them and CPA to just kind of see what makes the most sense for you guys. But definitely something everybody should be doing, in my opinion. Like you said, if there's some extra cash at the end of the year, definitely something easy to put some money into. Real quickly, as we're sort of wrapping up, could you just touch on sort of what we mentioned earlier, like family members, or just to be what to watch out for when you're trying to do deals with people and things that you should do or shouldn't do, or prohibited members, I think is how you worded it. Just as we kind of wrap up here.
sure, yeah. So yeah, great to touch on that as well. So we were talking about those prohibited transactions. So those are transactions that you'd want to stay away from doing with the self-directed IRA. So that would include examples like if I own real estate, for example, I can't live in that real estate. I can't directly make any structural changes to that real estate, such as new flooring, putting on a new exterior, anything like that. So we always tell people no structural changes to the IRA by yourself personally. You would want to hire a contractor or a non-disqualified person to do that work for you. So like you'd think brother and sister, cousin, family member that's not directly in your lineal bloodline, then that would work to ultimately pay those people for some of the rehab and the fixing that needs to happen with that property. So that's kind of like the first one, don't work on the property yourself, vacation in the property. And then the other one would be, let's say I own that piece of real estate. I wouldn't be able to rent that out to my mother or my father because they're in my direct lineal bloodline. So can't rent the property to my mom or dad. And then I can't rent it to my son or my daughter either. because they're going up and down in the family bloodline. So specifically prohibited transactions where those apply. Now I can rent it or sell it or otherwise transact in some way with it between like a brother or a sister. Totally fine. Cousin is totally fine. More of a distant family member, that's totally fine, but just can't be up and down the family tree. So that's kind of how it pertains to real estate there. And then the other ones that you want to be aware of, these are mostly going to be like for private equity transactions where it's a little bit more of a corporate environment. So if I'm CEO of a company, for example, and I want to use an IRA to invest into an entity that I have direct ownership in that company, that ownership would have to be below 50%. It's still considered a bit of a gray area if it's close to 50%. So that's what we often will tell people. Like a lot of these transactions, the thing with the prohibited transactions as well is they're not clearly defined, some of them. They're extremely vague and they're open for a lot of like interpretations. So you'll hear attorneys that will kind of give a different perspective on like
Sure.
the exact same clause there. So that's why, it's always good to like connect with a company like us or CPA just to have a conversation because we see a lot of what we call like we call them gray area transactions, and it's basically we're stating we can administratively process this. We're going to basically write that we're administratively processing it, but we're not approving of this investment in any way. We're not endorsing this investment. So if it comes back that there's any sort of legal action down the road, then and unfortunately, it would just go directly to you, client, because we're just a passive
Yeah.
custodian. So
Yeah, it's always a
that's
good
what
rule
we
of thumb.
usually tell people.
If you're not sure or on the side of caution, and I think the tax penalties are fairly high if you sort of is deemed that it was like not really the right choice, but they'll do the best to guide you guys in the right direction. Is there any other sort of common myths or questions or things that you'd like to bring up or mention? I mean, I thought it was really thorough. I think it's a great quick way to just give people a snapshot of what's actually possible and something that they hadn't heard about before. So I thought it was pretty comprehensive.
Yeah, yeah, appreciate that. I would just bring up that you can do like group deals and family deals. We didn't really touch on that, so
Okay.
we're seeing a lot more of these. So, like if you have IRA 401k funds and you have a group of investor friends, for example, or you have people that are in your family, you can invest alongside them if it's a new transaction. Like if I wanted to invest, with my spouse, if I wanted to invest with my mother and my father, and I had IRA funds and they had IRA funds or they had cash on hand, we can partner and line up all the money together if it's a new transaction that we're going into. And then we're buying that collectively as a group. So that's usually the main thing that I think people think that's a prohibited transaction, but it's not if we're putting together as a new transaction.
Oh, awesome. Yeah, yeah. And it will include his information in the show notes, phone number and everything to connect with him on social media, book a call or whatever. But yeah, no, I appreciate you hopping on, man. It was good to see you the other night and give our investors and people just some perspective of what's possible out there. And I'll include your information in the show notes, and we'll send you some stuff so we can get this thing going online. And if you want to share a copy of the slides too, that's fine too. If people had trouble viewing or just want to take a look at some of the slides after, we can make sure that you guys get that. So I appreciate everybody
Sure.
for tuning in. Thanks, Owen, for your time today, man. Appreciate you, brother.
Yep. Appreciate it. Yep. Thanks for the time. And yeah, let me know if anybody has any questions. Happy to jump on that with them.
Awesome. Thanks, man.
Yep. Take it easy.